A crash in the commercial real estate market remains one of the biggest risks to the U.S. economy and housing market. In today's video, we're going to look at the latest data to assess if the crash is imminent and what to look for in the months to come. Let's get into it. Higher interest rates brought on by the Federal Reserve's fight against inflation are widely expected to trigger numerous defaults on commercial real estate loans, and some borrowers will be faced with little choice but to hand over the properties to the lenders as the cost of financing their loan has increased dramatically and the underlying property value has dropped significantly. As I pointed out in my last video on this topic, when it comes to a crash in the commercial real estate market, we're looking at office properties for the most part, and things aren't getting much better. New data from commercial real estate services company CBRE showed that the vacancy rate for the office properties in the U.S. hit 19% in the first quarter of 2024, up from 18.6% in the fourth quarter of 2023. Notably, the office vacancy rate continues to trend higher each quarter with no notable sign of slowing that trend so far. It's clear from the office vacancy rate that there are some serious problems in that sector of the commercial real estate market, and it's not getting better. But there's something strange going on with the average asking rent for office properties. You can see here there was an initial drop in the first half of 2021 as the work from home phenomenon kicked in, but since then office rents have actually trended higher, and as of the first quarter of 2024 the average asking rent had fully recovered and was actually higher than where it was before the pandemic. Now, this didn't make much sense to me at first. It defies the logic of basic economics. When you have an excess supply of a good or service, vacant office space in this case, the price of that good or service should go down. But here we have the exact opposite. The high vacancy rate for office space in the U.S. keeps going up, but the price, the asking rent, is going up as well. Like I said, it defies basic economic principles. A recent article from the Wall Street Journal provided some insights into why this is happening. Basically, office property owners are doing everything they can to keep rents high so that the property value doesn't go down. You see, in the commercial real estate market, producing a valuation for a property is much different than in the residential market. On the residential side of the market, there are so many homes being sold each month that a real estate agent or property appraiser has plenty of data on comparable properties to come up with a valuation for the property by way of comparison. There's more to it than that, but that's the basic approach for most residential valuations. But on the commercial side of the market, you don't have hundreds of thousands of office buildings selling each month, so you need a different approach. Valuations for commercial properties are tied more to the income potential of the property, which makes rent one of the main inputs for an appraisal when seeking financing. If owners were to lower the rents to attract new tenants, it could significantly lower the appraised value of the property. So, why does this matter? The fact that the average asking rent for office properties remains high and is even trending higher means that there are still a lot of owners that are trying to keep the property value up, most likely for purposes of refinancing the current debt before it comes due. This means that we can look at asking rents for office properties as one of the metrics in assessing if the commercial real estate collapse is imminent or already begun. With average office rents being higher right now, it doesn't look like that crash is imminent, and other data are suggesting the same. Here's a graph of commercial real estate loans, which are primarily for commercial mortgages. We can see here that commercial loans haven't yet slowed down. Commercial and industrial loans, which can be used for working capital or capital expenditures like purchasing machinery, are showing some weakness as they are trending sideways for the most part, but have yet to take a nosedive. One critical metric to look at is the delinquency rate for commercial real estate loans. We're seeing it head higher, but unfortunately this data is quarterly, and the most recent we have is from the fourth quarter of 2023. We should be getting an update for the first quarter of 2024 soon, and that will be a key data point to watch as it comes in. The latest data is, for the most part, showing that a collapse in the commercial real estate market is not imminent at this point. Another question is whether this can be avoided altogether. Does there have to be a crash to get things back into balance? After all, it's primarily the office property market that is the most at risk right now. Perhaps things could stabilize in the months to come. To answer that, we need to consider the two main factors that contributed to the problems in the office market to begin with: the Federal Reserve's interest rate hikes to fight inflation and the work from home phenomenon that began during the pandemic and has led to high vacancy rates. With respect to the Federal Reserve and interest rates, I covered this in a recent video. Any interest rate cut is months away and is going to depend primarily on what happens with inflation. But even when a rate cut comes, it is likely going to be just a quarter-point cut at a time, which isn't going to provide immediate relief for commercial loans that need to be rolled over this year. On the other point, the work from home trend, the latest data isn't showing any signs of that reversing course either. Here's a graph of the percent of workers that are spending some or all of their hours working remotely. This is what the Bureau of Labor Statistics calls teleworking. As of April, this was 21.5%, down from 23% in March. A few caveats about this data. The Bureau of Labor Statistics started collecting it in October 2022. It's a new data source, somewhat experimental, and it's not seasonally adjusted. You have to have at least 3 years worth of data before you can adjust for seasonality. All that being said, it's the best hard data we have right now on how many people are working from home each month. That big dip in April is likely due to seasonal issues. We can see there was also a big drop back in April of 2023 as well. But the overall trend is clear. More and more people are working remotely for some of their work hours. It remains to be seen whether that drop in April is the start of a new trend or just due to seasonal issues. So we'll have to keep an eye on it as the new data comes out each month. We do find some interesting trends when we dig into how many people are working remotely part-time versus full-time. The percent of teleworkers that spend some but not all of their work hours teleworking was 52.4% in April, down slightly from the previous month. These would be people that are likely in a hybrid work situation. When we add in the percent of teleworkers spending all of their work time remotely, we see a much different trend as it has been steadily heading lower since the beginning of 2023. What we're seeing in the BLS data on teleworking fits the overall narrative that hybrid work arrangements are remaining quite popular and less employers are opting for letting their employees work remotely on a full-time basis. The main takeaways from this teleworking data is that the work from home phenomenon continues. Hybrid work situations appear to be what is the driving force behind this. While hybrid work arrangements will produce some demand for office space, it won't be what it was like before the pandemic. Right now, we just don't have the fundamentals in place for a solid recovery in the office property market. Rents are still high, which suggests a crash is not imminent at this point. I'll be releasing another update on the state of the commercial real estate market next month, so make sure you are subscribed and hit that notification bell down below so you know right away when that video comes out. I'll also have updates in the weeks ahead on inflation and mortgage rates, the overall economy, and what it all means for the housing market. Lots of great content coming. Make sure you're subscribed so you don't miss it. And if you found this video useful or at least mildly entertaining, make sure to hit that like button to support the channel and help it grow. Thanks for stopping by. I'll see you in the next video.